Good afternoon, ladies and gentlemen. I, Ankit Kedia, Associate Director, CRISIL Ratings, welcome all of you to CRISIL webinar on the fertilizers sector titled The Fields Turn Fickle. I would like to highlight that the webinar is being recorded. The format of the webinar will be as follows. Presentation by CRISIL Ratings team, followed by panel discussion with industry experts, and then a Q&A session towards the end. Today we welcome as our panelist Mr. Abhay Baijal, Chief Financial Officer, Chambal Fertilizers and Chemicals Limited, and Mr. Manish Gupta, Senior Director, CRISIL Ratings Limited. Coming back to today's theme, as most of you would know, the international prices of key fertilizers have more than doubled, led by supply constraints, geopolitical reasons, as well as high input cost as of natural gas. In this backdrop, the key question that crops up is how the high fertilizer as well as raw material prices will impact fertilizer industry in India, given its sizable dependence on imports. Our presentation today will attempt to cover aspects such as impact of Russia-Ukraine, high gas as well as other raw material prices on demand and profitability of fertilizer players in India, and how it may translate into subsidy bill for the government for the fertilizer sector. Let us look at the key findings first. First and foremost, the impact of Russia and Ukraine war on the fertilizer import for India is expected to be moderate, since India's dependence on Russia is low except for the potash-based fertilizers. Additionally, India is trying to offset the impact by tying up with other countries such as Canada, Israel, and Jordan for meeting the requirements, and is also trying to establish alternative mechanisms for financial transactions with Russia. For sectors demand and supply, the fertilizer sales is estimated to have declined by 6% during fiscal 2022 due to uneven distribution of monsoon and unavailability of fertilizers in the international market, especially during the first quarter of the previous fiscal. We expect the sales to grow at a moderate pace of around 3% in the current fiscal, factoring expectation of a normal monsoon. Import dependency in urea is expected to reduce due to recently commissioned and upcoming urea capacities. However, for non-urea, the raw material unavailability constrains new capacities in the country, and so the imports shall continue. As for the subsidy, the raw material prices have jumped to an unprecedented level, and therefore the subsidy requirement during current fiscal is expected to increase further. The announced subsidy budget is likely to fall short by a substantial amount, and additional subsidy will therefore remain a key watch out for the sector. In terms of the credit profile of the companies, urea players' profitability is expected to remain stable, while the profitability of non-urea players will be dependent on the revision of NBS rates by the government, which is expected anytime soon. Therefore, credit profile is likely to remain largely dependent on additional subsidy budget for this fiscal, since inadequate subsidy budgeting may lead to high working capital requirements for the companies and weaken their debt protection metrics. Let us now understand each of these views in more detail, and I would like to hand over to Snehal for the same. Over to you, Snehal.
Thank you, Ankit. Before we begin with the detailed presentation, let me quickly take you through the fertilizer ecosystem first. The Indian fertilizer industry is dominated primarily by urea and complex fertilizers. The fundamental difference between these two categories of fertilizers, apart from their nutrient composition, is the difference in the subsidy regime under which these two fertilizers operate. The subsidy dispensation for urea is done under product-based subsidy scheme, where the MRP is fixed by the government and subsidy is computed as the difference between the total price and the MRP. Whereas complex fertilizer operates under nutrient-based subsidy scheme, called as NBS scheme, under which government decides the nutrient-wise subsidy each year. Based on the announcement made by the government, the subsidy for different complex fertilizer is calculated for a particular fiscal. The MRP for the complex fertilizer is fixed by the companies. We have shown two scenarios, each for urea and complex fertilizer, to demonstrate the difference in the subsidy regimes. As you can see in case of urea, the MRP is constant, and in case of complex fertilizer, the subsidy is constant despite change in the total price. We will now move on to discuss the demand and supply dynamics in the sector in the next slide. In this slide, we have shown how the fertilizer sales has moved over the last few years, as well as the outlook. Fertilizer sales has grown at a CAGR of around 2.9% over the 5 years through fiscal 20, as shown in the chart. The demand for fiscal 21 grew at around 10% due to above average monsoon with good spatial and temporal distribution. However, due to unavailability of fertilizer in the international market and uneven distribution of rainfall, the sales was lower by around 6% during fiscal 22. Since the country continues to remain import dependent in both urea and non-urea segment, the impact is largely seen in the imported segment instead of domestic production. Going forward, we believe that the sales will grow at a moderate rate of around 3% during current fiscal, since the fertilizer consumption per hectare of arable land in India is far lower than the other countries. Also, we have seen that the complex fertilizer sales has grown at a higher pace as compared to urea. However, due to high raw material prices and availability challenges in the international market, the demand growth for non-urea fertilizer is expected to be slightly lower to around 2.5 to 3% in fiscal 23. This assumes normal monsoon and no major increase in the fertilizer prices during the current fiscal. Any significant increase in the prices by the players may impact the non-urea consumption going forward as well. Now, let us look at how the country looks to meet the increasing demand for fertilizer in the next slide. The left chart on the slide shows the import dependency on the individual segments. As you can see, the country continues to remain import dependent on both the urea and non-urea segment. Dependency is higher in non-urea segment due to unavailability of raw materials like rock phosphate and potash, while the dependency in urea manufacturing is towards the LNG imports. The import dependency in urea is expected to reduce in current fiscal due to ramp up of the recently commissioned capacities and upcoming capacities as shown in the right chart. The Gorakhpur unit of HURL was commissioned in December 21. Ramagundam and Matix fertilizer have started operations, and 2 new facilities in Barauni and Sindri are expected to come up during the current quarter. In complex fertilizer, availability of raw materials remain a constraint, and hence the sector has not witnessed any major capacity expansions over the past several years, while some debottlenecking projects have improved the production levels as well as operational efficiencies for the companies. Going forward, the government is now working closely with Department of Mining and Geological Survey of India to expedite the exploitation and ramping up of the production of phosphorite deposits, as well as the exploration of potassic ore resources in India. This may increase the indigenous production and reduce the import dependency for non-urea segment over the medium to long term. Overall, the import dependency for urea is expected to reduce to around 15%, while it is expected to remain around 25 to 26% for the non-urea fertilizers during the current fiscal. We will now move on to discuss the impact of Russia-Ukraine war on the supply aspects. Before assessing the impact, let us discuss the global trade dynamics and India's dependence on the countries for the imports. In this slide, we have presented the details of 3 key fertilizers which are imported in India, which includes urea, DAP, and MOP. Urea is the largest consumed fertilizer globally. China is the largest producer and exporter of urea, followed by Middle Eastern countries, while India and Brazil are one of the largest importers. India imports urea largely from China and Middle Eastern countries. Moving on to DAP, MENA region has the largest deposits of phosphates, and hence they are one of the largest exporters of DAP. They, along with China and Russia, form around 75% of the exports globally. India imports DAP mainly from China, US, Saudi Arabia, and Morocco. In terms of MOP, Canada, Russia, and Belarus have the largest deposits of potash, and hence they are the largest producers and exporters of MOP. India imports MOP from Canada, Russia, Belarus, and other Middle Eastern as well as European countries. In the next slide, we will show the trend of the import dependency of India on the Russia, Belarus, and Ukraine. In the left chart, we have shown the trend of total fertilizer imports from Russia, Ukraine, and Belarus. As you can see, the imports have largely remained in the range of around 10 to 12% in most of the years. The dependence is higher, around 30% for the potash-based fertilizers and raw materials specifically, as shown in the right chart. The dependence is very low for urea, other non-urea fertilizers, as well as for the natural gas, and it can be easily substituted to other countries. We have shown the import dependency of natural gas also in the bottom graph. Government is currently in discussion with other countries like Canada, Jordan, and Israel for tie-up of the fertilizers, especially the MOP, and has also directed some of the companies to import and store fertilizers for the upcoming Kharif season to minimize any supply impact. An MOU has already been signed with Israel Fertilizer Company for supply of MOP till 2027. Since the import of MOP by India forms less than 5% of the total global trade, the impact is expected to be moderate. Moreover, to resolve uncertainty over payment and logistical issues, the government and RBI are exploring alternative mechanisms to process financial transactions with Russia, such as bilateral trade in rupee and ruble. In the next slide, we will show the movement of the raw material and imported fertilizer prices and its outlook. In the top chart, we have shown the trend of pool gas prices and gas consumption by the fertilizer industry over the past several years and its outlook for the current fiscal. Pool gas prices is essentially a mix of domestic and imported gas operated by GAIL. As you can see, the prices have jumped by around 80% during fiscal 22 to reach around 1,050 rupees per MMBTU, primarily driven by the increase in the domestic as well as LNG prices, both spot and contracted. In the current fiscal, pool gas prices are expected to further increase to around 1,200 rupees per MMBTU due to increase in the domestic APM prices and sustenance of the contracted and spot LNG prices at elevated levels, as shown in the bottom chart. The APM prices have already been increased to $6.1 per MMBTU and is expected to remain in the range of $6 to $7 during the current fiscal. Overall, with this increase in the pool gas prices, the manufacturing cost of urea is likely to go up in the current fiscal. In the next slide, we will look into the imported raw material and fertilizer prices and outlook for the same. In the left chart, we have shown the international urea and DAP prices, while in the right chart, we have shown the international rock phosphate and potassium chloride prices. As you can see, the prices have started increasing since first half of fiscal 22, primarily due to increase in the global energy prices and export ban by China, which is one of the largest exporters as shown previously. Currently, the prices have increased further due to Russia-Ukraine war and uncertainty associated around it. Especially, the prices of potash has increased considerably in the past 1.5 months. Going forward, the prices are expected to remain elevated during Q1 of current fiscal and is expected to normalize from June 22 onwards, given China is expected to resume exports and the situation in Russia and Europe is expected to ease. We will now move on to discuss the impact of the same in the subsidy requirements in the next slide. This chart shows the build-up of the subsidy areas over the years. As on fiscal 20, the total areas were around 48,000 crores. During fiscal 21, the government provided an additional subsidy of around 62,000 crores, leading to significant reduction in the areas for the companies. Coming to fiscal 22, the unprecedented increase in the raw material prices, especially the pool gas price, has led to increase in the subsidy requirements for the year to around 1.5 lakh crore. The government had initially budgeted around 80,000 crores. However, given the increase in the pool gas prices and the prices for other raw materials and imported fertilizers, the government increased the NBS rates for the non-urea players and also increased the subsidy budget by over 60,000 crores. This has restricted the increase in the subsidy areas in fiscal 22. Considering the increase in the raw material prices, especially the pool gas prices, the subsidy requirement are expected to increase to around 1.65 lakh crore during current fiscal, assuming there is no change in the NBS rates. Since the budgeted amount as of now is 1.05 lakh crores, this is expected to create a shortfall of around 75,000 crores by the end of next fiscal. While the government has been very supportive in terms of providing additional subsidy of over 60,000 crores for the past 2 years, any additional subsidy during the current fiscal will remain a key monitorable. Moreover, it is likely that the government may increase the NBS rates for the potash component since the impact of Russia-Ukraine crisis is majorly in the potassic fertilizers. Hence, we have also shown a scenario wherein if the NBS rates of K increases by 100%, that is from 10 to 20 rupees per kg, the subsidy requirements will increase further by 2,500 to 3,000 crores. In the next few slides, we will present the impact of the same in the profitability and other key credit metrics of the sector. For the purpose of this assessment, we have considered companies which form around 60% of the total fertilizer sales in India. In the left-hand graph, we have shown the EBITDA per ton for the urea players, while the right graph shows the EBITDA per ton for the non-urea players. As you can see in the left graph, the EBITDA per ton for the urea players have largely remained stable, driven by the pass-through of the cost of natural gas despite variations in the past. The companies are entitled for the agreed fixed cost by the government. The reduction in EBITDA per ton during fiscal 22 is primarily driven by the revision of energy norms of some of the companies which are in the process of completing the energy saving capex, and the profitability is expected to bounce back in the current fiscal. For the non-urea, the profitability is linked to the ability of the companies to pass through the variation in the raw material prices in the final fertilizer prices, as well as the fixed NBS subsidy which is provided by the government. The profitability has improved over the past few years, with companies focusing on increasing the efficiency in manufacturing and having long-term strategic tie-ups with global raw material suppliers. However, during fiscal 22, the EBITDA is lower due to increase in the raw material prices, while the government asked the companies not to increase the end product prices and raise the NBS rates only for the P component while keeping the rates of N and K at same level. In the current fiscal, the profitability will be dependent upon the NBS rates, which will be announced by the government shortly. We have shown two scenarios wherein in case of as-is situation, that is no change in the NBS rates, the profitability is expected to reduce further, assuming government does not allow the end product prices to increase any further. The second scenario assumes the increase in the rate of potash by 100%, wherein the profitability is expected to sustain. Hence, the announcement of NBS rates remains critical for the profitability of the non-urea players this fiscal. In the next slide, we will present the impact of all these in the key credit metrics. In this slide, we have shown the historical trend of key credit metrics as well as the outlook for fiscal 23. We have shown two scenarios here. The as-is scenario reflects the situation wherein there is no change in the NBS rate, and also there is no additional subsidy provided by the government. While the second scenario factors increase in the NBS rates by 100% and additional subsidy of 60,000 crores similar to last year. The left graph shows the trend of interest coverage ratio, while the right graph shows the debt to equity ratio. As you can see, the credit metrics improved substantially during fiscal 21 and fiscal 22 due to additional subsidy from the government, which resulted in lower working capital borrowings and interest expenses for the companies. In the next fiscal, additional subsidy will keep the credit metrics afloat, while absence of additional subsidy will result in increase in the working capital borrowings and interest expenses and subsequently bring back the metrics to near previous levels. Hence, the additional subsidy remains critical for the credit metrics to sustain and therefore will remain a key monitorable going forward. This brings me to the last slide of the presentation. Just to summarize, fertilizer demand is expected to remain steady during current fiscal. Import dependency in urea is expected to reduce, while it is expected to sustain for non-urea. Impact of Ukraine-Russia crisis is expected to remain moderate in Indian imports. Government is tying up with other countries to minimize the supply impact. Substantial increase in the raw material prices is expected to increase the subsidy requirements, and therefore the subsidy budget is likely to fall short substantially. The additional subsidy and the change in NBS rates remain critical for sustenance of the credit metrics for the fertilizer players. There are also some key emerging trends in the sector which will be a key watchouts, such as capacity expansion in the non-urea segment replacing the bag urea, use of green hydrogen and its associated policies, and change in the regulatory scenario, like implementation of actual DBT to the farmers. With this, I conclude this presentation and invite Nitesh to initiate and moderate the next section, that is panel discussion.
Thank you, Snehal and Ankit, for an insightful presentation. Before moving to our next section, I would like to announce that CRISIL Ratings has recently launched a mobile app, Ratings Analytica, and a portal, ratingsanalytica.com, to offer high quality, timely, and actionable insights by combining data, domain expertise, and decades of institutional experience. We have been receiving several requests from the audience for the webinar presentations. I would like to inform that even presentation for today's webinar will be available on our mobile app as well as portal in next few days. You may also download the mobile app by scanning the QR code visible on your screen. Now we will move to the panel discussion, which is a key highlight for today's event. So let me, during the panel discussion, we would also be running a poll to know the participants' view on the fertilizer sector. So now we begin our panel discussion, which is the key highlight for today's event. I welcome our first panelist, Mr. Abhay Baijal, Chief Financial Officer of Chambal Fertilizers. Mr. Baijal is an engineering graduate from Delhi College of Engineering and a management graduate from IIM Calcutta. Mr. Baijal has rich experience of more than 3 decades. Prior to Chambal, he has worked in various renowned organizations such as Hindustan Unilever, Birla Home Finance, and CRISIL. Welcome, Mr. Baijal. Actually, Mr. Baijal is stuck in some urgent meeting. He should be joining us shortly. Our next panelist, Mr. Manish Gupta, is a Senior Director at CRISIL Ratings Ltd. Manish is responsible for a large portfolio of corporate and infrastructure sector clients. He is also a Senior Rating Committee member. Manish is an MBA from ISB Hyderabad and an engineer from IIT Kanpur with over 2 decades of experience. Before joining CRISIL in 2004, Manish has also worked in Indian Oil Corporation. Welcome, Manish.
Thanks, Nitesh.
Once again, we thank both the panelists for joining us today. And as I said, Mr. Baijal should be joining us shortly. So until then, there are a lot of questions from the audience which you have taken at the time of the registration. I thought let's discuss those questions first. And Manish, the first question I would request if you could take up. So the question is largely coming on the subsidy budget, because in our presentation also we did talk about the subsidy budget of 1.05 and the likelihood could be higher. So what's your view on the subsidy and how do you see the subsidy budget panning out for this year?
Yeah, I think as you guys rightly mentioned, subsidy budgeted for this year is just a little above 1 lakh crore. And this is going to be definitely falling short of the requirements for this year. I think our present estimates suggest subsidy requirement of around 1.6 lakh crore in the current fiscal. We are already seeing the pool gas prices rising as high as $18 per MMBTU in March. We expect that these high gas prices may continue at least for a couple of quarters more. And may fall down subsequently. But so this is what we are currently baking in when we are saying 1.6 lakh crore for the current fiscal. However, in case the gas prices still remain high or at the current levels, this subsidy requirement can go up to as high as 1.8 to 1.9 or even touching 2 lakh crores, which will be like a double of the subsidy budgeted for this year. So that's at least what we're seeing at this point in time. On subsidies, Ritesh.
Thanks, Manish. And Snehal, if I can address the next question to you, and this question has come from Mr. Amitav Chakravarti, MD and CIO of Kitara Capital. So his question is, how DAP or phosphate pricing outlook in India currently unremunerative for manufacturing or trading?
Yeah, thank you, Nitesh. So basically, the DAP prices have recently been already increased by the companies few days back. And this is primarily because of the increase in the input cost. While the government has not yet announced the NBS rates, however, the further increase in the prices may fall short for the non-urea players. And the NBS rate announcement will certainly remain a key watch out here. and that will play a key role for any further increase in the DAP or the non-urea fertilizer prices. So as soon as the government announces the NBS rates very shortly, which is expected, probably we can see the impact on the prices. However, we believe that the government has been supportive in terms of controlling the prices, just like last year. They have been requesting the companies and the players not to increase the prices and supported farmers to that extent. So hence, if there is a substantial increase in the NBS rates by the government, probably we could see that the prices remain under control for this fiscal.
Okay. Thanks, Neil. Just a connected question, Manish, and just coming back to you. And this question is largely on the profitability. If we see, as Neil was also saying on the NBS rate, etc., that's a key input from a profitability point of view. So what's your outlook on the profitability for urea as well as non-urea?
Yeah, I think you're right. I mean, the profitability impact will be different for both urea and non-urea, as you rightly mentioned in your presentation that the business models per se are also different in terms of subsidy. So for the urea players, the key component impacting the margins is natural gas. Here, the variation of this gas prices are passed through to subsidy bills, and hence we do not expect the profitability to be impacted for the urea players. Margins still may vary, and that variation can be a function of the actual energy consumptions which are there vis-a-vis the norms which are set up by the government. We have seen that some of the companies have recently completed their energy saving capex, and hence actually we may see an improvement in profitability for urea players in the current fiscal. So this is for the urea side. And coming to the non-urea players, here subsidy is fixed and players are free to change their MRP to reflect the input costs as well as the competitive scenario. So as a matter of fact, here the companies have increased the prices by over 10% just a few days back. We, however, believe that this may not be adequate to offset the entire increase in the raw material cost that we have seen. Last fiscal also, we have already seen a dip in the profit margins for the non-urea players since rates were increased only for the P component, as was also highlighted by Snehal. Going forward, to maintain profitability levels, either the NBS rates needs to be revised by the government in line with the rise in the raw material costs, or the companies would need to increase the prices. So both of these aspects will be important and critical, and will be a key monitorable for the non-urea players to sustain their profitabilities. This is what as of now we are seeing on the profitability for these fertilizer players.
Thanks, Manish. And there are certain questions on the live chat also, and I will address one question which is from Tushar Gupta. So Tushar, when we say current fiscal, yes, you are right. That is FY23. That's the year which we are referring to. So there are questions on the green hydrogen, and let me address that question. And the question is from Amol Singh. So what is the expected impact in cost of fertilizer with the introduction of green hydrogen? And Amol, let me address this question largely from the urea manufacturing, because the gas is the key component in the urea manufacturing. So as you know, the urea is the manufacturing is more like a cost plus. So today, whatever the investment has been done, that's being reflected in the price or the pricing mechanism rather. If you see any further investment, be it green hydrogen or something, obviously that has to be done in line with the government policy. So government needs to come out with the policy for the green hydrogen, and that needs to be built in from a pricing point of view. So moving on to the next question, and Ankit, if you could address, there are certain questions on the input prices for urea, essentially the gas. So what's the outlook which we have on the gas prices?
Yeah, sure, Nitish. So in case of fertilizers, we basically use the term pooled gas prices, which is a mixture of domestically produced gas, which comes at a APM price. And then we also have the contracted LNG, and the shortfall is then met through the spot LNG. So right now, if you look at the APM prices were recently revised to $6.1 per MMBTU, effective 1st of April 2022, which would be applicable for the next 6 months. So which is a revision from the $2.9 per MMBTU price. So one can clearly see that it is more than double. Similarly, the contracted LNG prices are also expected to average around $11 to $12 per MMBTU for the current fiscal. And though the spot prices are difficult to predict, but anyways, their proportion in the overall mix is low. And therefore, here, as we have also mentioned in the presentation, that in the first half, the prices or the pooled gas prices may remain at an elevated level of around $18 per MMBTU, which would come down in the second half with the softening of the contracted LNG and the spot LNG prices.
Okay, thanks, Ankit. So there is one question from Deepika Mehta. She has put up a question on the DBT implementation. So Deepika, as you know, and let me address this question. So DBT implementation, there are two level of DBT one can say. One, the DBT which is in the current form, where even today the DBT technically has been implemented. The way it works is the fertilizer manufacturer are being paid this subsidy at the time of, or that is linked to point of sale machine, POS machine. The moment farmer buy the fertilizer, and that's the point when the fertilizer companies are being paid the subsidy. So that is being done. I think you are referring to the direct subsidy which is being directly paid to the farmers. So I think that there is no additional update at this juncture. So let me take it forward, and there's one more question, and Snehal, if you want to take up that question. So the question is from Sneha. She's asking what would be the impact of the disruption in the fertilizer segment on food prices. So it's largely the food prices and the food inflation.
Right. So, Nitesh, in case of the food inflation will be dependent on how we are, passing on the prices to the farmers. Now, clearly, in case of urea, the prices are fixed, and roughly around 50 to 55% of the total fertilizer consumption in India is urea, while the remaining is non-urea, that is DAP, NPK, MOP, and SSP. Now, for the urea component, the prices are fixed by the government, and the remaining is passed as a subsidy. So there is no change in the prices for the farmers, and that would certainly not impact the food inflation to that extent. And for the non-urea prices, the fertilizer players have already increased the prices by around 10%, but they may not be sufficient. Secondly, the fertilizer, the cost of fertilizer in the overall food production is also very small compared to the food grains and other costs that the farmers spend. So the impact to that extent for the increase in the non-urea fertilizer prices in the food inflation is also expected to be lower to that extent. Secondly, if there is an increase in the NBS rates by the government, then probably the increase in NBS non-urea fertilizer prices will also be limited, and that would something be supportive for the food prices to remain at current levels and not increase by a significant amount. So therefore, the food inflation is something which is not expected to go significantly higher than what it is at a current level in the current fiscal.
Okay. Thanks, Neil. So let me ask a question, Manish. It's linked to the credit profile and the financial debt metrics. So this question has come from Anurag Singh, SVP Yes Bank. So the question is, the financial risk profile of all the entities in the fertilizer sector improved as on March 31st, 2021, with additional allocation of subsidy. Now that we see phenomenal rise in the fertilizer prices, will this impact fertilizer entities? Government is already facing several challenges on various fronts with respect to the budgetary constraint. Do you expect ad hoc additional allocation for subsidy for the current year?
Well, Government has definitely provided additional subsidy in the last 2 years. So what it appears is that they are certainly seized of the affairs of what's happening around. And the intention of the government is also very clear that they're likely to continue to provide the support. At least that's what we see at this point in time. The fiscal headroom, whether that will be available for the government, and also how they will react to the NBS rates, that still remains a key monitorable, and we will have to look at that aspect as we move forward. So I think that's like broadly what we say. It's a bit uncertain and will be quite dependent upon how government reacts on the current situation.
Okay, thanks, Manish. So while we have addressed this question, but Ankit, there is one more question on the natural gas. I'll just put it for you. Mr. Anil Vaishak, Piramal Capital is asking this question. So any government intervention expected to provide subsidy in natural gas for the fertilizer industry? That's the question. You're on mute.
Okay. Yeah. So sure. So the government already, provides support through subsidy to the fertilizer company, and that is, to compensate for the natural gas prices. So that support is already there, and we expect it to continue.
That's right. So, Anilji, the answer is that the natural gas prices for urea manufacturing is already passed through. So whatever the pooled gas prices, that is being built in, and while the retail price remains the same, whatever is the delta is being compensated by government directly to the manufacturers. So, Manish, there is one more question pertaining to the credit profile. The audience is asking that given the significant strengthening of the balance sheet in last 2 fiscals, benefiting from the adequate subsidy or other additional subsidy, and we have seen the clearance of the area, which is a key issue from credit rating point of view of the fertilizer companies. So do you see the reversal of these improvement as subsidy will mount up for the government? And what's your view on the credit profile of fertilizer companies?
Okay, sure. Thanks, Nitesh, for asking this question. I would say that, under budgeting of the subsidy as well as increase in receivables, this has been an industry level issue for long. We have seen that subsidy receivables have been as high as 200 days until fiscal 2020. This actually led the fertilizer companies to borrow heavily in the past for their working capital needs. And apart from that, this not only led to increased financial leverage, but also results in higher interest costs, which eats into the net profitability of fertilizer players. Hence, this definitely is a credit issue, and it's an important monitorable for us. Now, again, repeating the point that giving due credit to the government, I think they are seized with the matter, and they provided almost 1.2 lakh crore of additional subsidy in the last 2 budgets. This resulted in substantial reduction in the subsidy receivables, and consequently, the leverage has also come down quite materially. Having said that, the level of subsidy receivable will still remain important monitorable insofar as credit quality of the fertilizer players are concerned. This sensitivity around receivables has only increased in the current scenario because we're yet to hear from the government on how they will be reacting on the situation. In case of any lower incremental allocations by the government, we may see increase in the subsidy receivables and thereby debt levels for the fertilizer players. Having said that, we also factor in that these receivables are backed by the government, and there is a track record of support available, such as additional subsidy or a special banking arrangements and all. So hence, there is some bit of a confidence that we build into this and not treat it as a normal receivable. But having said that, continued high receivables may restrain the financial flexibility of the companies and eventually impact the credit profile of players as well, and hence it's an important monitorable still.
Thanks, Manish. So both subsidy as well as the NBS rate are the monitorable. Good afternoon, Mr. Bajal. Sir, you are on mute, it seems. So while we were waiting for you, sir, we thought we will take up some of the other questions. Thanks for joining in from your busy schedule, sir. So let me come directly to the question, Mr. Baijal, and we did discuss about various aspects on the subsidy, credit profile, natural gas prices, etc. So my first question to you, Mr. Baijal, is we are seeing very unprecedented time, and fertilizer is one of the most impacted sector due to this ongoing conflict, and taking a call on the demand, etc., could be like a crystal ball gazing. But let me still, you to reach out to you and understand your perspective. That how do you see the global situation currently, and what could be the likely impact on India?
No, definitely there is a large supply side shock. Russia was an important or is an important supplier of fertilizers and other commodities to Europe. So, for instance, most of their DAP, calcium nitrate, NPKs, grades, all of them came from their 3 or 4 companies, Eurochem, Fosagro, Arcor, and so on and so forth. Now, I am told that the government of Russia has been going through a process of putting export quotas and so on. There is some, within inverted commas, discussion about unfriendly countries. My view is that the Europe is quite heavily dependent on Russian commodities. They will make a lot of noise. That noise will create a tariff barrier kind of situation. And generally the flow to Europe will reduce. Now, obviously, either Europe then imports the grains, produces less, or does some kind of other balancing by taking material from North Africa and other places, China, for instance. Now, they are in a bind. China, Russia together, they are not going to, allow too much of, because that leverage that Russia has on commodities, especially fertilizer. My reading is that there must be some tacit understanding between China and Russia also, not to give a free pass to the Europeans on this. So generally, they will now go back to North African producers. And North African producers will see heavy demand, basically Morocco, maybe Egypt, maybe. So those Algeria, those kind of countries where there are maybe surpluses to export. And on the phosphatic side, there will be heavy demand coming from Americas, as well LATAM, Brazil, and so on. On to 1 or 2 people, that is Morocco, SABIC, etc., all those people. So they will have their hands full. So once their hands are full, their quotas to places like India, which are also deficit, will be, they cannot also ramp up capacity because, these chemical plants can be, debottlenecked to 2, 3, 4%, but you want a quantum jump in terms of supplies, then that's not possible. It's not a seamless growth. So obviously there will be shortages, rationing, allocations, quotas, and people generally will have to do with less fertilizers, in my opinion, all over the world. And that will cause price spikes, which are already happening. That will create its own dynamic in terms of either plantations being less or whatever. And the resultant impact will be a general reduction in food supplies across the world. In the next season, the food supplies being less, stocks being drawn down, will create even more pressure to generate from the land. And so the dynamic will be in all places is to plant. So the next to next season will be even worse in my opinion in terms of pricing. Even though there will be some relaxation, because my own impression of the war is that it is now reaching a stalemate phase. And in a stalemate phase, both parties have to sit down and work out the best face saver for each other. Okay. Now, what are the terms on either side? I'm not nobody knows exactly what are the terms on either side. But in terms of time frame, I can say that it looks like being resolved in summer, which is June, July kind of time frame. Thereafter, the sanctions will get loosened one by one. And there will be some acceptable formula, pay those much for damages, this, that, blah, blah, blah. Some or two commissions on inquiry of war crimes from either side and so on. So at the end of the day, this whole thing will start unwinding by July, August, September.
Sure.
And then it should settle down by December. So better part of this year, at least 3 quarters, we have this situation. And with the result that the Kharif and Rabi season, at least in India, will go with either very high prices or maybe to some extent certain. See, India, fortunately, and the advice of the industry, India did stock up on phosphatics to some extent, especially DAP, in the months of January, February, when we came out of the Kharif season and we met personally with the secretary and the ministers and so on. It was emphasized by the industry and appreciated by the government that this is a very large operation inside the country. We are requiring between DAP and NPK about 20 million tons and plus or minus another 2-3 million tons. And therefore, we need a stocking level of at least 2 to 3 million tons at all times. And so we need to build up the stocks. So this thought process has been well appreciated, and the government went ahead and allowed companies or gave them assurances to import and so on. And also produce. So I think Kharif season for the country is more or less covered as far as phosphatics are concerned. Urea is not a problem. We only pay more for gas, and somebody, as I entered, was mentioning in terms of escalation claims and so on. But at least the production is there, and we have got Gorakhpur starting up in HURL. Matix has already started producing. Ramgundam is not fully to capacity, but I think 1 or 2 equipments were giving trouble, but that they should be able to sort it out in another 3-4 months' time. So we have added capacity actually in this period. Must give credit to the government that they thought about the, this issue, gave the policy for new plants, and those plants have started coming on stream. So urea, I would say by and large the situation is okay. We have also imported about 1.3 million tons, a fairly good prices, 595 levels.
Okay.
In February, the government opened a tender, and that also came. So we are, as far as the stocking for Kharif is concerned, is not very much a problem.
Okay.
As I said, the problem is if this lingers on or the sanctions create problems, because you must also remember that there has been large-scale destruction. Odessa, Mariupol, Pevdeni. These ports are also in trouble in terms. Even if you produce, you have to evacuate out of certain. There are logistics challenges. Now, I do not know exactly what the situation is in Black Sea, but Black Sea generally is out. Now, that has created its own set of problems for other supply chains running into Morocco, for instance, where they are producing DAP. And there is also a problem of sulfur supplies, which is quite a bit of that comes from Russia. So sulfur is shot up to unprecedented levels, $450 levels. That has its own impact on sulfuric acid, and sulfuric acid thereby has an impact on phosphoric acid costs. Roughly 1 ton per ton is required for the production of phosphoric acid. So if $300, it has gone up from $150 level, sulfur has gone to $450. That $300 will definitely feed into the prices of all other things being equal, will definitely feed. So prior to this crisis, we were running 780, 790, 770 levels. So 1070 levels though is anyways there because of the sulfur issue. And sulfur is not an issue which is going away because sulfur is also dependent on supplies coming from refineries. When sour crude is refined, then the sulfur is produced. And you know that because of disruptions that have happened in COVID and so on, plus move for electric vehicles, and now this supply is not coming from Russia and all that, or lower running of refineries, middle distillates and so on. As a result of that, you know that there is another crisis which is there in Europe, is diesel crisis. And diesel crisis is such an acute one that people are saying that within 3 to 5 days, if the supplies are not made, I mean, they are running on consumption to stock ratio of, ridiculously low levels of 3 days, 5 days, 7 days kind of situation. So with that being the case, the sulfur supplies are tight and will remain tight at least till the end of the year. So we are looking at a very high cost phos acid, which feeds into high cost DAP, and the same price at the same time because of the disruption in ammonia supplies. There is also another cost driver. So everything that is about phos acid, which is sulfur, and on DAP with respect to ammonia, both are getting hit and driving the prices up. And so will also with all other NPKs, at least till October, November this year. That's my own impression.
Thanks for the... Yes, sir. No, sir, thanks for the comprehensive answer. And the near-term challenges, especially for the complex fertilizer, is there, but urea, you said, is largely covered. So, sir, this is a demand side story. Supply side story. How do you see the demand for both urea and non-urea for the current year? Any estimate? What's your view there?
That I say the demand would depend on. I'm not an expert, but somebody has to run through World Food Organization tables and see the stocks, consumption levels. Normally, countries do maintain at least one season's consumption. That is, normally every country has 2 seasons, maximum 2.5 or 3 seasons of plantings.
Sure.
So, if you were to see population 7.6 billion people, multiply by calories and divide by the so many food grains, I'm not an expert, but I don't know what the stocking levels are today.
Sure.
And with the kind of shocks that are there are exporters like Ukraine and Russia, which provide 25% of wheat of the world. Also stuff like barley and so on. So it will have impact on beer prices in any case. But as far as wheat is concerned, I mean, that is a fairly big staple and very largely consumed in North African countries because there's no agricultural output there. Also in Southeast Asia, they are major importers. So I am seeing a very big demand side inflation in food prices. Already the impact of that is being felt in food stores all over the world. And I would say that food inflation would be a major concern for many countries, especially in Africa, where their purchasing power is less. And we could witness towards summer food riots, starvation level situations in terms of stocks and so on. Now, what does it have to do with the demand? Obviously, once the demand goes up, prices go up, farmers will, so-called in the words of the US Department of Agriculture, get price signals to plant more. The plant more will feed into more demand for fertilizers. So my feel is that that's how I said that even going forward, the demand will pull the prices even if supply starts normalizing. And this interplay between demand and supply will somewhere settle around mid of 23 or so on if all things go well. And there's no crystal gazing available with us to tell us how this situation is going to be. And I think the entire situation will re-stabilize to previous levels in 23-24 second half kind of situation. This year is the year of the shock. The shock is traveling around the world at the moment as we speak. It is causing its first order effects. Second order effects will come in another 6-8 months time and then start dying down. So it's like that kind of a wave which is traversing the markets. That is how I see it.
So I think a very important point which you raised from a demand as well as on the supply from a global point of view. But in the Indian context, if I just put it, and especially I would say that from the NBS rate, because that's where you also pointed that the disruption would be higher. And we are yet to see the increase in the NBS rate. And obviously in our projection, we did factor in doubling of the the NBS rate for the potash from 10 rupees to 20. And again, it's an estimate at this juncture. But what's your view in terms of, let's say, the rate? Obviously, difficult to gauge the rate increase. But let's say whatever the situation, would you see that the companies would be able to pass on the increase to the farmers?
I would say that this is another year where the companies will have to satisfy themselves with moderate margins.
Sure.
Given the fact that the government is exercising some kind of, I would say, legitimate control on the retail prices, whether said or unsaid.
Sure.
Now, obviously, its fallout has to be on the NBS rates for subsidy, which we expect are to be such that which should cover current costs, maybe future costs, and even some kind of reasonable return and so on. Now, that will put big strain on government finances. Now, if the government has to take a call that there is a question of availability and also a question of supplies and the question of compensation to companies who are either producing or importing. So government will have to balance this within the equation.
That's true.
And they will have to continue to have the trust of the company, I'll put it this way, that they will supply them or grant them that adequate subsidy so that they are not out of pocket. And because if there is any time a feeling with the company that they will be out of pocket, they will stop importing or producing.
Very true.
So it will then impact the supplies, and you must understand that, for instance, as far as importers are concerned, they still have one lever of control. But insofar as the producers are concerned, they have to be continuous in their production process. That means even as we speak, they are importing material, rock, sulfuric acid, ammonia, etc., not knowing what exactly will be their revenue, given the fact that the NBS rates are not yet finalized. So it's a toss-up, and you can't blame the companies for clamoring for a conclusion on this issue, but the government has its own reasons. They are also waiting and watching and seeing how the things play out. They don't want to preempt, and they don't want to be too late either. They have to give some assurance and at the same time not give a signal to the world market that they have an infinite put on the government of India. That whatever price they give, there is a put option that they have. At every price level, there is a put option. So then, otherwise, then you are only writing checks for the rest of the world. So that is also one of the concerns. Okay, if prices rise, then how much and what should be the level to the farmers? Now, level to the farmers is also a political question. It's not merely an economics question. So it's a complex interplay of factors, but my feeling is that the government are well aware that the companies have told them in no uncertain terms that if you don't give us a proper understanding, I will not say pricing, understanding. By the middle of April, then there is difficulty to continue. Nobody can keep on taking unlimited risk and strain their balance sheets. There are boards, there are rating agencies, there are ratios, there are liquidity ratios, there are all kind of ratios and coverage ratios. All that can get impacted if the proper decision is not taken, because unfortunately this is also the year end and where the audits will have to be done and publishing of annual results will have to take place. So at that point of time, all the measurements are done, relevant measurements are done. And nobody wants to spoil his financial track record. So government is aware of all that. And therefore, I think some resolution on this issue should be available another 10-15 days time, my assumption.
That's really comforting, and in fact, just Manish was saying the same thing, that the way we also do the rating, we factor in that these are sovereign receivable, but at some point in time they need to get liquidated if they are building up.
No, that one part is the cash flow, the other part is the commitment. See, here is a question of what is the commitment of the government in terms of the number. Financing that cash in and out is a different issue. That is, companies can manage that. But if you don't even know what exactly the number will be, then there is closing the annual accounts itself will be an issue.
Moving on to the maybe one more question we can take up given the interest in the interest of time. So the question which is coming in, even many of the audience have asked this question, and if you look at as India, we have a significant reliance on the import of the fertilizer. So what are the steps government or the industry is taking to augment the domestic production? That's part one of the question. And we have been building a lot of alternatives such as biofertilizer, nano urea, green hydrogen. So if you could share your views on both these aspects.
My view, let's start with the bottom heap first. Nano urea, biofertilizers, green hydrogen.
Sure.
Green hydrogen will lead to ammonia only. At the end of the day, there's no difference. With the hydrogen obtained from natural resources like wind and this and that, it all depends on what is, and you have to do it by electrolysis of water. So electrolysis of water is a very energy intensive process. All depends on what is the cost of renewable energy. Supposing you were to use hydropower at 80-90 paisa per unit, a different equation. If you want to do electrolysis with 6 rupees per kilowatt hour, that's a totally different equation. Okay, so it all depends on the source at which the electrical or cost of electrical power is coming. Okay. Green hydrogen is just a thought that we could produce ammonia by not burning. So it's a decarbonization measure. It is not a cost measure. Cost measure will come if you have got cheap energy. There is clearly a energy costing issue. What is the cost of energy which goes into feeding your urea ammonia plants? Okay, whether you are using fossil, non-fossil, whatever the case. Now, supposing you are using fossil and you are getting gas at $20, for today is the case as the case is. Now you will be out of the market as compared to what is being produced in Qatar, for instance, where the cost may be $3 or $4. So it all boils down to the cost of energy. 70% of cost of urea is coming in by way of energy cost. Balance is all other costs such as capital cost, conversion cost, and so on and so forth. Now, if you come to the real issue which is there, nitrogen, for instance, is the basis for making ammonia. Nitrogen is freely available in air. So there's no cost to the real raw material as such. It's only cost of transforming it from air into bringing into a utilization factor to convert, react it with hydrogen and make ammonia. But in the case of phosphoric acid or the case of potash, these are natural resources which are not accessible to India because they are not available in India. The supply chain or the value chain basically lies outside. There is no other option but to go for some kind of arrangements, investments, or taking some stake in those kind of places over a period of time and properly timed to low commodity cycles. Okay. There's no point in, at this point of time, going at high commodity cycle peak and trying to acquire assets which will bankrupt you over a period of time. But there is always a point that you will have to say that what is the long-term situation going to be. And we have seen that at one point of time, we were getting phos acid in 2000, 2002, 2003 time frame at $110, $120, $130. The same damn thing is, they are talking $2,000. Okay. Same way you see ammonia was, basically tied to natural gas prices. Natural gas used to be considered a throwaway. It was considered a byproduct of, petroleum extraction or crude extraction. And that was associated gas. But gas came into its own the moment technology developed in order to transport it, liquefy it and transport it and create supply chains on the basis of floating, putting it into ships and then taking it out, then regasifying, then all that kind of thing. So that is how they unlocked value in natural gas. Now natural gas by itself has now become a rival to crude to some extent. We are using it in transportation, we are using it for cooking, and we are using it for fertilizer and so on and so forth. Okay. Now, natural gas, it depends whether India has or does not have and what it can do to secure supplies going backward. I don't know how that, not an expert on that. But as far as phos acid, potash, etc. are concerned, there are only 5-6 places in the world where you get potash. Now, can you develop stuff like they're talking about potash from molasses, they're talking potash from seaweeds? What is the extent of potential of that type of is something which technology has to develop to prove. So government are trying all these things. They're talking to people, trying to do pilots, understand exploiting and understanding when we will scale up, what will be the cost, the technology development board and so on. So they are talking. A lot of these things are being talked about. Nano urea is I don't know whether to call it a breakthrough or innovation or at the moment I would put it somewhere between a trial and an innovation, where it is being yet to be proven in its completeness. But what it and how it does, whether 2%, 3% improvement and so on, that's definitely the third thing that the government can do is to look at efficiency of utilization. See, quite a bit of the application of urea or this thing might also be going waste. They say that 35 to 40% is the uptake in nitrogen efficiency in urea. Now, supposing you were to improve it by 5-10%, to that extent, without reducing yield, you could improve or reduce the amount of nitrogen or this thing. Fourth thing is policy measures. Should you increase the price of urea to bring it to a level where excessive or wasteful use is brought down? That is another possibility that we will do. And fifth is to look at modalities of manufacture. Should you manufacture phosphatic fertilizers directly from rock or should you make it from phos acid? Now, the difference between the two is that if you've got a phos acid plant converting it to starting from rock, then you have a capacity to blend from various supplies, provided you have the capacity to deal with igneous, non-igneous rocks and the various impurities that come and utilize those, technical issues. I'm no expert, but that's what I hear or I've read. But at least you can get rock from Morocco also, Peru also, from Jordan and so on and so forth, and you can make some cocktail by which you can manage, okay, 2 or 3 places. But supposing you had only phosphoric acid, then you normally get tied only to one source. That's the only. So you may have to enter into long-term supply contracts for phosphoric acid, or you may like to develop plants which now, so far, hitherto, there have been issues in terms of gypsum disposal and so on. Now, I'm told that there is this sensitivity about phosphogypsum and so on, which is now dying down to some extent. And 2, that the gypsum is available or could be used by cement industry. And if it is used by cement industry, then there is a natural, without creating heaps and mountains about the gypsum, you could actually be disposing it and actually make some money out of it. So then it, those kind of things, the downside is that putting up a phosphate plant pretty expensive. The capital cost per ton could run in to the extent of something like $900 to $1,000 per ton annual capacity. So if you are looking at a 400,000 to 450,000 ton plant, you could, it could cost you 450, it could cost you 550, depending on, that's a pretty large investment for people to make. So there the question of appropriate pricing, then the capability to pass it on within, because you are competing with imports. If you are starting from there, you need some kind of PLI or I don't know what those kind of things are there. I have not studied the matter in great depth, but my opinion is that, like in urea, where we have at the cost of the taxpayer and others, created attractive return on investment structures for people to come in and build plants, which we have done and which HURL are doing and others are doing. At least the capacity gets built. And once the capacity gets built over a period of time, it's one way or the other a national asset. And same way, if you create, and my own opinion on this matter in various forums, I have told people that the phosphoric acid to final capacity that we have or consumption that we have is pitifully low. You need to build at least 2 plants or 3 plants and bring in at least 1.4, 1.5 million tons of phosphoric acid capacity to get out of some of these situations. Because if you want to store phosphate as a stock and stock it, the best way to do it is phosphoric acid. Storing it as rock is a difficult proposition. Storing it as a final product is also problematic. Where is the space to keep that kind of, it will be costly also. But you can, if you have an own manufacturing capacity, you can create phosphoric acid and store it in tanks and use it as and when. So you can create kind of like strategic petroleum reserve. You could create a strategic phosphatic acid reserve. Entirely my thinking. I'm discussing this or thinking aloud in this matter. But these are the ways in which the country can look to forget about the pricing, the sheer availability issue, and the impact it has on food security sometimes keeps me sleepless at night. So that is something which the government ought to consider in detail and think about and work with the industry to work out some packages by which capacity gets built.
Great, sir. I think it's going to be joint effort by government and the companies. So we would actually like to continue this interesting discussion, but given the paucity of time, we will now move to the question and answer session. In fact, we have taken most of the questions already. But before we move to the next segment, I would like to inform that a feedback poll will shortly be visible on your screen. I request you to share your feedback by selecting appropriate option.
So, Nitesh, do you want me to remain or I could leave?
Sir, if you could remain, we are just closing in 5-10 minutes. Sir. It would be really great if you could remain for 5-10 minutes. So, ladies and gentlemen, we will now begin the question and answer session. You will be able to see the Q&A chat box at the bottom of your screen. If you have a question, please type your question there along with the name of your company and await for your turn. And Mr. Bajal, there is one question already, and if I can read that out question for you.
Yeah.
So this question has come from Anurag Patel, and his question is, what is your view on possibility of fertilizer prices impacting farm level productivity or the usage in coming Kharif, which are some of the fertilizer intensive crops, and it says per acre requirement that can be impacted?
My point is that farmers are smart enough to have correlated fertilizer usage with productivity, pricing, and so on. And if you have read reports in the newspaper in the past, this year the prices are going to be elevated. Already merchants and traders are making inquiries. Crop has been harvested, most parts of MP. They are also, as we speak, getting harvested, and there is good demand and good pricing. More money in their hands means they will invest more. And all depends on government's subsidy announcement, because that has a direct bearing on the market pricing. My understanding is that there won't be any impact.
Okay. So there are other questions, but we have largely covered, and special thanks to you in terms of addressing many of those questions. So due to shortage of time, I would like to conclude this session. And if there are any further questions, please write to events@crisil.com. On behalf of CRISIL Ratings, I convey our sincere thanks to all of you for taking part in today's webinar. We hope that you found today's discussion insightful and timely. We also hope that your queries have been answered satisfactorily. And I express my deep felt thanks to the speaker for the evening, Mr. Bajal and Mr. Gupta, for sharing their insights, experience, and precious time today. With this, we conclude today's webinar and look forward to connecting with you in our next webinar on rating roundup, which is just day after tomorrow at same time, 3 o'clock. Thank you and goodbye. Thank you, Mr. Bajal.
Thank you.
Mr. Bajal.
Thank you.